Hello folks, this is part 2 of how I would restart all over again if I had to go back and do it all over again. It's a completely blank slate, no experience whatsoever, and only having access to the YouTube level content that I put on my channel. Before I get into this one, just a book recommendation for you. This is The Mental Edge in Trading. This is Jason Williams. He is Larry Williams' son. Now, while this isn't really a technical trading book, it's more along the lines of the things I'm going to talk about here. Now, I'm not trying to reduce this book's effectiveness in covering the things I'm going to mention briefly here, but I will mention that Larry Williams brought this up early on in my career. I was first exposed to the idea of matching personality to trading styles by Larry Williams' courses that I discovered and purchased in 1995. So his son naturally carried on with that school of thought and becoming a doctor and a psychiatrist. He ended up making a book with his father's experience in trading, and I guess growing up and listening to his father talk about the ins and outs of the psychological aspects to trading and how traders many times fight to do something they're not really equipped mentally to relate to. And I'll give you my personal experience and how I think about things and how I am from a personality standpoint and how that matches up with a specific trading style. So I would first obviously consider my personality, and I would try to match my personality to the appropriate trading style. Now, what does that mean? Well, there's lots of different ways to trading. There's scalping, day trading, short-term trading, swing trading, position trading. My personality is I'm quick fused and I'm prone to changing my mind frequently. So while that may seem like indecisiveness on the part of someone that doesn't really understand what I mean by that, it just means that I can see lots of opportunities and I can see micro market structure in price, and I can draw a relationship between that and opportunity for me to get in and get out. So in other words, I can see a framework in lower time frames rather quickly, and I can get in and get out rather quickly. So my personality personally lines up with day trading and short-term trading because I like to take a lot of executions. I like to get in and out and parlay my equity up. That's the goal as a short-term day trader, is to get in, take your surgical strikes, and get out. Try not to overstay your welcome. I do not have patience to sit in long-term swings. So with that, it helps me narrow down my focus. And I don't care how well someone else does trading in catching 1,500 pips, 2,000 pips, 3,000 pips for a year, holding on to these long-term trades. I just draw no affinity for that. Short-term trading allows me to keep myself in my own lane, try not to worry about putting on more stress than it's necessary, and I really remove the whole aspect of performance anxiety, which will obviously be a thing for the males in this career when they first start. They feel like they have to do something else in addition to what they may already see working early on. Now, I'm not saying everyone's going to find success early on, but those that do find success early on, they make the mistake of looking at other people and saying, well, I'm not doing what they're doing, and that means I'm probably not doing as much or as well as I should. And you change lanes, and that changing of lanes many times will take you out of what you're really prepared to do the best in. And that means, like, I'm not really good holding long-term positions because I'm going to see 30 different position opportunities in a week. Well, that doesn't fit well with someone that is expected to get into a trade and hold it for months at a time, because I'm going to be wrestling with, man, that's an opportunity for me to go short here and I'm long. It's problematic. So this book, I think, also helps match up your unique personality. It helps you discover what your unique personality is and how it might relate to a specific style or approach to trading. And I personally enjoy the frequency of trade setups and intraday charts. So I don't spend a lot of time on monthly and weekly. Just once in a while I'll get a long-term perspective, and that usually stays in motion for a number of weeks. So I'm not trying to flip-flop back and forth with my expectations, and I try to milk a specific bias that higher time frame's already outlined. Now, obviously, when we get into trading, we're met with all kinds of flash and glitz and image and all of that colorful thing that tries to get your attention. The opposite side of that is the quant side. So you have Instagram traders, fakes, and then you have the left side where it's quants. They're highly mathematically derived, system-based, rule-based ideas, and they're kind of like the nerdy crowd. So there's going to be two schools of thought for you, and I would really elect to go with the quant side because I'm analytical. I have computer science background, information systems, and computer programming. That side of things is more appealing to me, and I'm a numbers kind of guy. I've never been an image person, even though I did do that kind of stuff as a young man. It doesn't give me the satisfaction of just beating the socks off the marketplace with data. And you're going to have to decide that early on too. But I would not go towards that Instagram crowd like I mentioned in the first volume of this series. I would keep my focus only on one market and avoid switching markets sporadically. That means if I don't have a trade set up, or if I don't see something that is producing a condition in the marketplace that I could operate favorably in, it doesn't mean I'm going to abandon that market. It just means I'm going to learn patience and sit and wait. That part of your development is crucial. And this is the reason why I teach my students to focus on one or two markets that are closely correlated and measure that against a benchmark like the dollar. If you don't have the patience to wait for your setup, you're going to rush to do things and gamble. And the only way that you form and forge patience is to develop it by sticking to one market and identifying when it's not trading in a condition that's favorable and just being patient. It gives you clarity. You don't guess about whether or not you should be doing something or not. You don't abandon your market simply because it doesn't give you the opportunity that you usually take right now. You simply wait because you know what you're looking for. So early on, when I first started trading commodities back in the early 90s, I would jump from one commodity to the next. If it didn't give me a setup, I knew that if I looked hard enough, I would find a reason to get into another market. And sometimes that was painful. I would lose a lot of money and it would make me angry, and I'd say, okay, well, I'm not making any money in this green. I'm going to go into the meat market, and I would trade feeder cattle, or I would trade pork bellies or lean hogs, something to that effect. And if I took a loss there, then I would say, okay, well, I'm going to go in, I'm going to trade crude oil or heating oil or unleaded gas. And then if I took a loss there, I'd jump into cocoa or sugar. I would jump all over the place sporadically. And that's a loser's cycle. And you don't want to start that, and you want to enter this whole process with a professional mindset and perspective. That means think of an Olympic contestant or an athlete. Okay, you don't see an Olympic athlete going from the swimming pool to the shot put, okay, or trying to throw the discus, or to do the relay race. They specialize in on one thing, and they're only going after the gold on that one specific event. And they're really focusing and narrowing their focus on one specific process that they believe will lead to their superior result above everyone else, and the gold. That's what they're after. They're not trying to be the master of every Olympic event. Same thing with these markets. A professional trader is going to be focused on one specific market, narrowing their focus and knowing what it is they're looking for. And I'll cover a little bit of what that would be and how I could use the YouTube channel to formulate that idea. But keeping your focus on one market is important because you'll learn when not to do something and you'll know when to do something. You won't feel the tug of war of emotional and psychological effects of not doing something, because the gambling aspect of trading won't be an enticement for you, because you know what you're waiting for. If it's not there, you simply wait, because you know, given enough time, that specific market will give you a setup. I would build a study journal of back testing that single market or asset class. And I would start with the euro dollar. Now, what do I mean by study journal? And what is back testing? What would I be doing? Well, I'd be going into the charts. And since my preferred outlook on the marketplace is short-term to intraday, I would have an hourly chart of the entire week. And with that hourly chart showing Monday through Friday, I would look for old highs and old lows where the market traded above an old high, rejected, and go the other direction. Or I would watch where the old low was taken out by a lower low and then reversed and went the other direction. And I would study that market structure in those two reference points. Now, initially, I would not be trying to pick the weekly range or the direction. That's not what I'd be trying to do in the beginning, because it's easy to trick yourself into thinking you know what you're doing and then being discouraged when you don't. When you find out later on you don't know what you're looking for. So to do things at a very modular pace and slow pace and realistic pace in development, I would focus in on optimal trade entries and how that would be easily determined looking at the marketplace, as I'm going to show you in this volume. And this would be done at least 6 months. So for 6 months, I would expect myself to submit to back testing and logging in a study journal the way I'm going to show you in this. So what does it look like when you're back testing and filling up a journal with 6 months of back data? Well, as I mentioned, I would have an hourly chart, and this is exactly how I started as an S&P and bond trader. When I stripped away all the retail stuff, I used the S&P market and the bond market. Why those two markets? You said one market, Michael. Well, it's essentially one market that I was following, which was bonds. But because bonds and S&P are inversely related, so in other words, bonds go up, S&P goes down, and vice versa. If one goes up, the other one goes down. So it doesn't make a difference which market was giving me the setup. I knew if I could relate it to the other, it would support the opposite view. So since I'm still working with one market, it's the same thing as if I was using the euro dollar against the dollar. I want to make sure that what I am anticipating in the euro dollar is the opposite in the price action in the dollar. So on an hourly chart, I'd take the entire week and break it up from Monday to Friday. This would all be done after the fact, okay? Because the whole pantomime here is I'm developing, and how would I teach myself to go through the process of developing with a steady learning curve and not waste a lot of time? You start with an hourly chart. Also, let me preface it by saying this is my approach. This is where I would have gone back if I could and do this very thing, because I would have learned at a quicker pace. Not that I'm speeding you along, but because if I would have figured out early on what my personality is and how it would relate to trading, day trading and intraday trading, you only need an hourly chart. You don't even need a daily chart. You don't need a weekly chart. You don't need a 4-hour chart. You don't need a monthly chart. You don't need any of that kind of stuff. You just need to look for market structure at turning points, okay? And at key intermediate term highs and lows, that's all you would need to focus on. What are they? Well, if you look at this chart here, I have a high here, and this is a Monday. It trades up on Tuesday, runs that previous high, and breaks down. Trades lower the next day on a Wednesday, trades higher than this high here, then trades lower. We have a low here, it trades down below that, and starts and turns the other direction as well, after also this low taking out that. So all I'm looking for is intermediate term highs and lows, and are they traded through, and is there a possibility there's going to be a rejection? Because I don't need the market to trade 300 pips in my favor. I don't need it to trade 200 pips in my favor. All I need is 50 pips. 50 pips, and I can do as much as I want, taking that same 50 pips and repeating it every single week. So what I'm focusing on is learning how to find one setup or multiple setups that would net me a 50 pip net result for the week. Because that's the first thing. You got to set a target for what it is that you believe that you could do consistently on a weekly basis. Do not set the target for 50 pips a day, because you're not going to hit that. Okay, you are not going to hit that, period. You want to have something spread out over the course of the entire week, and 50 pips is only 1/2 of a penny move in Forex. So if I'm only trying to get 50 pips, even if I don't get my full targets and I just get 10 pips each day trying to do this procedure, in theory, I could get 50 pips that way and still never hit my ultimate targets. So even in failure, reaching my milestone each week. This is crucial because I put too much emphasis on being right in the beginning of my development. And every single time I had small little modular wins on paper. Now, these were live trades back when I was trading, but when I say I had paper profits, they were unrealized. They were only showing that if I would close the trade, I would have this much money in real dollars in my account. But I would hold on to it for my targets and never understood the concept of taking partials along the way and paying myself. So before I would learn that, I would teach myself and condition myself to do what I'm going to show you here. So each day you split the hourly chart with vertical lines. They may not be that visible here, but there's one here, 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 and here. It's Friday's trading, and then the end of Friday's trading is there. So all I'm looking for is intermediate term highs and lows where the market trades above it, and then once it does that, does it break down? And I'm going to go into these areas and study it on a lower time frame. 15-minute time frame is all that's necessary. And the same thing in here, same thing with this low there, okay, and same thing with this low being taken there. And you study it and you look for these specific characteristics. Now on Monday, we can see that the market trades above this short-term high here and above this short-term high there. So we're only going to look, for the sake of brevity in this volume, because I could obviously talk for 6 hours and bore you to sleep, but I could dig really deep with this just in this one whole chart here on this hourly chart. But we're just going to look at just one specific day on that Monday, and the whole framework is this short-term high is being violated there, and we're going to look at this fractal right there. All right, so here's the 15-minute time frame on May 10th, 2021, and here is the naked price action. And what you want to do is, in your study journal, you want to take the chart and have it set up where you have it naked, no annotations, nothing. And you want to have the access to areas in your chart where you can write out your own annotations after the fact, because you're going to dress this up, but you're going to learn later on, a week later, a month later, 3 months later, when you come back to it, you're going to see what the market has done since these specific days. And this is how you teach yourself, by repetition, seeing how they all nest together. Each individual day's price action, basically a small component or a cog in the greater scheme of how these markets move and book. So you want to start with a very simplistic approach and a good 15-minute time frame in an hourly chart for the whole weekly range. And you do this every single week, and you do it for 6 months. You don't try to demo trade. You don't try to go in with a small live account just to see what it feels like and feel the psychological tug of war like everybody that doesn't know how to make money tells you to do. That's nonsense. You're going to start with the wrong foot first doing that. The way you go into these markets and you learn how to do it without any emotion, without any fear of losing, is to simply desensitize yourself to that whole aspect of it needs to be right. Because it doesn't need to be right. You don't need to be right. I didn't need to be right in the beginning, but I felt that I had to be right all times, 24/7, every single trade. And that is problematic. It conditions you to have unrealistic expectations. So we have to just strip this thing down into a simple pattern recognition approach to seeing something that repeats over and over and over again. Well, let's take a closer look at this specific day. When you annotate your chart for your study journal, you want to find the optimal trend entry that occurs between 8:30 in the morning, and 11 o'clock New York local time. That's what you're going to annotate here. Okay. Here's the high. It trades down below a short-term low here. So that's a shift in market structure. It rallies back up inside of this shaded area here. That's optimal trade entry. 79% retracement level, 62% retracement level there. The idea is that you're going to use the 62% retracement level as your hypothetical entry. Now, this is all hypothetical. You're not attempting to do these trades. All you're doing is building a study journal, which is back testing old data. So what this does, it helps condition you to see specific elements to these ideas and then watching it flesh out and build up as time goes on. Well, if you look at how this market goes from this high down to this low, shift in market structure, rallies back up, you go short right there. This is the first time the candle touches this price level. The stop goes just above this short-term high, so your stop loss is there. 10 pips, nothing less. Every single example, you're going to backlog and show in the examples a 10 pip minimum. That's the least of a stop loss you can use. That way, you're not trying to convince yourself that you can go in 2 pip stop losses. Okay, avoid all that stuff for right now. 10 pips is reasonable. If you're using a 15-minute time frame, that's reasonable. It doesn't mean that you won't get stopped out. It doesn't mean that it's going to work like that in the future all the time. It just means that as a rule-based idea, going in, studying, back testing data, everything that's already happened, hindsight, you're looking at examples to frame out something that can build a respectable risk to reward model. Not that I have that as a dependence in my trades, because I don't look at it as I have to have this, I have to have that in terms of what I risk. You don't know what the market's going to give you. Just because you have your trade framed out with 10 to 1, you're risking $1 to make $10. You have no idea and no assurity that it's going to move $10 in your favor. No one knows that. I don't know that. There isn't a trader alive that's going to be able to tell you that's going to absolutely happen. Because if that was the case, we'd all be billionaires. But you have to have some kind of idea that you're going to submit to. Okay, so as a suggestion, and this is all this is, all of your framework, you want to try to set it up with 3 to 1. That means you're trying to risk $1 to make $3. If you do that, you have a really good chance of, over time, the losers being overtaken by your winners. And you don't need to have a high strike rate to be profitable, theoretically. So right here, we have 10 pips defined as our risk. And the market comes back up one more time. Note this. Okay, so anywhere over here in your annotations, you want to record how much time it took when it started the trade here. How much time did it take before it started really moving in your favor? I like to see 1.5 of what I have risked before I would consider moving a stop. That was one of the original ideas I had from my trading, is whatever I'm risking, it has to move 1.5 times that before I even move my stop. Now, if you have that rule-based idea, this return back into the general area where you got in would not stop you out. Many times traders would rush their stop down in here, and it comes back, knocks them out, and then it moves in their favor because they're so afraid to take a loss. Do not be afraid to take a loss, and submit yourself to the initial risk that you put on, and leave that there until it at least moves 1.5 times what you've risked. What does that mean? Well, it has to move 15 pips in your favor before you move your stop loss in any degree. And at that point, I'm only moving it to half the initial risk. Once it does 2 times what I've opened up myself for initial risk, in other words, it's moved 20 pips in my favor, then I go to break even. And you want to have that annotated here. How much time does it take for you to be able to do that? And you log that, and you simply do this every single day. Old lows is what you'd be aiming for. So there's liquidity resting below that. It's sell stops. Using your fib, you have an extension of -1. And I've already showed this on my Optimal Trade Entry pattern recognition series, which you're welcome to look at on my YouTube channel. It's in the playlist section on my YouTube. So this is the target, but we're going to be trying to get deeper into this sell side liquidity pool. So this is our target. To get this, we're going to assume that the market needs to go at least a good 5 pips below that. Now, why 5 pips? Some brokers have really tight spreads. Wouldn't that get me out? No. As a rule-based idea, you want to anticipate a 5 pip run below where you think it might go. So frame all your trades that way. So that way, once the market does in fact trade to that point, 5 pips below it, no matter what broker you have about a 90% likelihood that they'll fill you. That's why I have that rule-based idea. And you can see the market does in fact trade down to that level. So 5 pips below this target, below this liquidity pool, that's where you would have it marked. Now, when you have it marked up like this, then you want to start adding all the annotations. But the main thing is knowing when that shift in market structure occurs. That's what sets up your pattern. And then once you have it all fleshed out with all the annotations, and it doesn't take long to do this. It literally only took me less than 10 minutes to mark this chart up just like this. So even if you have a job, you have children, you have a family to take care of, whatever, okay, you still don't have to spend a whole lot of time doing this. And you're only doing it with one market. And once it's all marked up, obviously you want to fill in the details. What time did the short hypothetically fill? And what time did the target fill? So you essentially got in at 10 o'clock in the morning here on this candle. And hypothetically, you would have got out at around 8:45 p.m. Time in the market is 10 hours and 45 minutes. The drawdown was 3.2 pips. That means this highest candle right here went 3.2 pips away from where your entry was on this candle. That's why I'm teaching you to use a 10 pip stop loss, because it gives you a forgiving range where you don't have to be so precise and you're linking it to the old high. And if you start doing this for 6 months, you're going to have a backlog of historical data that is fleshed out in such a way where you can go back and see how these individual unique days are part of the weekly range. And then also how it is part of the monthly range. Like, how does this particular day, the 10th of May, 2021, how does it relate to the entire trading of the month of May? And how does it relate to the first quarter's trading going into the second quarter of 2021? Where is it in relationship to all of that? And the only way you're going to understand how these markets are fractal and how they fit together is by doing these types of exercises and teaching yourself by repetition what the pattern looks like, how to frame it over and over and over again. Even though it's hindsight and you can't trade it, it's teaching you how to recognize it and how to frame it. And you'll see that there are repeating phenomenon and characteristics to these specific, very simple approaches to trading that's taught for free on this YouTube channel that are consistent. They occur every single week. But all you need to find is one candle or high that's pierced, and if it breaks and it has a shift in market structure, which is a short-term low right before it creates the runner higher high, then you anticipate a optimal trade entry. The fact that it's hindsight, you're not going to have any fear of being stopped out because it's already happened, and that's perfect because you can't lose, you can't make money. You're only focusing on identifying the structure and pattern, and by knowing what that looks like, comprehensive approach to learning from back data, historical data where nothing can influence you from a greed standpoint or fear standpoint. You are taking all the psychological elements out of it, and you're taking the money out of it, and you're teaching pattern recognition. When you were in grade school and you were learning the alphabet, was it going to make you any money or take any money out of your pocket if you didn't know how to draw or write or recognize the third or fourth letter in the alphabet? No. You were being conditioned to do what? The same thing over and over again. You'd have a little ditto paper, okay, and they would give you the example of a capital A, and you'd have to fill the whole page up with a capital A over and over and over and over again. As boring as that was, your hand would hurt at the end of doing it, but you were expected to do that. And the next day, what letter would you be working on? The letter B. And what are you doing each day? Pattern recognition. Was it profitable for you? Not at the time, but now you can write letters, you can send text messages. It's useful information to you, but you started that way. Pattern recognition. You have to strip trading down to that elementary state where you're not influenced by anything monetary or psychological. You're not elevating yourself up with ego because you called something right, or you're not deflated because you got it wrong because it's already happened. And you're conditioning your subconscious to see this pattern over and over and over again. And as you go through and annotate, you're not limited to this. You can put more details in there as much as you want. How much time did it take before it moved 1.5 times your initial risk? How much time did it take before that would happen? And these are things that you would build up. And you're going to see these reoccurring characteristics are in the majority of these setups. And you're also going to relate to what day of the week these patterns are forming and how that relates to the weekly range. Which days produce the best setups for shorts? Which days produce the best longs when it's bullish? And keeping that log going, the rest of your career, that's what you're going to do. You're going to be doing this the rest of your life, charting and annotating your charts. But in the beginning, you have no idea what you're looking at on the hard right edge of that chart. So to eliminate all that fear and performance anxiety, just don't worry about that. Teach yourself pattern recognition. And using this as an approach to initially start it, this is how I would do it. If I was 20, starting all over again, just using what's on this YouTube channel, this is exactly what I would do. Until I talk to you again in part 3, be safe.